Okay, I think we will get started. Thank you everyone for joining us today, and I hope you all are keeping safe in these times of coronavirus. And hopefully, many of you are able to work from home. Um, I thought we'll do a little update on the market. There are a lot of volatility in traditional markets as well as crypto markets. And if you have any questions, we'll do a little Q&A at the end. There is a little chat box next to this video on the website. So you can ask your questions there and we'll take some questions at the end. But I'll just talk a little bit about what we see happening in the crypto markets and on the macro front the last few weeks. Um, so let's get started. So in February, we started following this website quite closely. Uh, this is, of course, the uh, Johns Hopkins website, their dashboard about coronavirus. And we said in February that this graph on the lower right side is probably the most important graph in the world right now. And this is the number of cases of coronavirus in the world. And why this is so important is, of course, that it's impossible to separate the virus from the economy. Um, and I guess we started following this in February, and it really increased exponentially already in early February. It's really hard to see on this graph because that area is so small right now. And we could all see what's happening in China and later in Italy. But I guess what really surprised us was that the equity markets didn't really react. They seemed really inefficient to us. Um, and it really took until sometime in February before the market really started selling off from the peak. So that was really surprising to us, kind of how unprepared the market was for this event to affect Europe and US. And what happened then was that we saw this enormous stimulus as the central banks and as governments around the world needed to lock down to protect against the virus and at the same time try to uh, save economy and save jobs out there. Um, this second tab here is showing a tweet from Raul Paul. He's one of the founders of Real Vision. You probably know him from there. He's also an ex hedge funder from GLG. And this shows the sell-off from February in equity markets and in Bitcoin as well. Bitcoin was not unaffected. And Raul is writing here that Bitcoin and S&P 500, which is the equity index in the States, are currently extremely correlated as liquidation pressure turns all assets into risk assets. It's not going to last forever, this correlation. We agree with him. But right now, markets are correlated. And what happened was that hedge funds, family offices have been buying Bitcoin as a macro hedge, and some traders have been buying Bitcoin on margin. There were a lot of leveraged traders out there, and when this sell-off happened, we saw very large liquidations on leveraged platforms like BitMEX and other exchanges. One day, BitMEX had over $600 million in liquidations over a 24-hour period. And it's also important to remember that the Bitcoin market lack any kind of circuit breakers or or other methods that you have in traditional markets that limit the sell-off on a daily basis. Um, Crypto markets can't be manipulated by central banks. They're trading on all these exchanges all around the world, and they don't abide by the rules of traditional exchanges. So the price discovery is happening very quick in the Bitcoin and the crypto markets. So this sell-off happened. Bitcoin went down below 4,000, and a lot of the leveraged traders were flushed out in this initial sell-off in Bitcoin, and it sold off together with equity markets as well. And what then happened was, as I mentioned, an unprecedented amount of stimulus going to the economy. I tweeted this on March 18, less than 1 week into US taking the coronavirus seriously. Mnuchin is here telling senators that they need a $1.2 trillion bailout, or unemployment will go to 20%. Of course, this was increased further. What happened was that the US went to 2 trillion in terms of fiscal stimulus. And this is after central banks basically cut interest rate to zero in the US. It was cut to 25 basis points here in Australia, which is the lower bound in Australia. And central banks around the world are restarting QE. So it's enormous kind of stimulus going on right now in the economy. As you probably have heard, Australia has enacted a $180 billion stimulus package, and that's not the end. There was another package coming out yesterday of another over $100 billion. So that's $180 billion is over 10% of GDP, and with the job seeker package announced yesterday, they'll probably take it to somewhere north of 15% of GDP. So these are enormous figures. The $2 trillion in the US is around 10% of GDP as well. The US GDP is around $21 trillion. And this is on top of everything that the central banks are doing. And the key here is that we believe that all this money printing will be bullish for scarce assets like crypto, Bitcoin, and gold. This is unprecedented easing, and money printing will increase debt levels, and it will at some point make fiat or regular currency less valuable over time. This is someone from Federal Reserve, and you can find this video on YouTube or on Twitter. I can't play the sound for you right now, but this is the Federal Reserve talking about they having an infinite amount of cash, and if you can print something in an unlimited fashion, and that will probably decrease of that thing over time. And in this case, we're talking about fiat currency or the US dollar, and that would be again good for things like Bitcoin or gold over time, we believe. So right now the correlation is very high, as I discussed, between, for example, Bitcoin and the equity market. But this is not really anything new as such. When we look at gold and the equity market, this is a chart from Willy Woo that looks at the 2008 financial crisis. And what happened there is that we had a sell-off in the beginning of the financial crisis in both equity markets and in gold. So you see here the first few months, both gold and equity markets sold off, and then gold has had a really strong run as it decoupled from the equity markets. and markets don't repeat, but they rhymes, and we think it's plausible that something similar will happen in this economic crisis. So right now, as the liquidity event happened, S&P 500, gold, Bitcoin all sold off, as you can see here on the lower graph. And we think the correlation between these markets will again start to decrease sooner or later. And we also wrote about this in a couple of pieces. So if you go to our website, we wrote a piece called Macro Update on March 17. You go to our website, and under blog, we write about our observations of the market. And here we wrote about the consequence of the lockdowns, the difference between crypto markets and other markets, and the lack of circuit breakers in crypto markets, which means price discovery is happening very quickly. And we wrote about the very big drop that happened in the crypto markets and the liquidations that happened on platforms such as BitMEX. So you can check that out. We also wrote another piece. This is by my colleague Tim Johnston. He wrote about crypto correlations and the coronavirus on March 24th. It's also on our blog. We wrote about the GFC here, and we look at the correlations between equities, bonds, and gold in this piece. And as you can see here, at the end of this graph, the correlation really goes higher in terms of correlation between crypto and equities and gold. So that's where we are right now. We believe correlations will decrease over time again as the markets decouple. Let's switch back here. So during this time, we've also seen some fundamental events in the crypto markets, and maybe most notable is that it seems to be a push to make crypto legal in India and South Korea. Those two pieces of news were sort of drawn in this market volatility that happened in the last few weeks. But to us, that seemed quite bullish. And also, as we have been talking about a lot lately, Bitcoin's supply is going down next, I guess, in 35 days or thereabouts, 35-40 days. Bitcoin will go through one of these halving events that happens every 4 years, where the supply will be cut in half. It's programmed that way in the software. So while the Federal Reserve can print an infinite amount of cash, the opposite is happening in the Bitcoin market, where the supply is going down. Another thing that I think is interesting is, well, we like to look at crypto kind of from a portfolio perspective. And we have many times been arguing that you should have a small percentage of your portfolio in something like crypto that has potentially a big upside. But if you don't put too much of your portfolio in crypto, then the downside is not too large either. So we think still that crypto is a really interesting portfolio hedge. And when we look at portfolio hedges, we see limited asset classes that can act as portfolio hedges in the current environment. Of course, you can have cash in your portfolio besides equities, but that doesn't really have a big upside. You can have kind of the traditional hedge in a portfolio is bonds, but that has limited upside as well, with interest rate at historical lows. So we believe crypto and perhaps gold are really interesting portfolio hedges that over time we believe will be uncorrelated, and where you still have upside. So we stay kind of firm with that view. On the macro front, sort of it's hard to know exactly the fallout of what's happening now. It's kind of depends a lot of how long social distancing and lockdowns will be in place. But many companies have less than 30 days cash on hand. So without government help, we will see a lot of bankruptcies. For the crypto market, uh, that really shouldn't affect assets as like Bitcoin. Um, but there are a lot of different assets in the crypto market, and some assets behaves more like VC investments. These are early stage projects that might need funding, etc. So that's probably where in crypto that you need to be a bit careful now. The crypto assets that act more like early stage VC investments, those might take a hit just like regular companies or investments. For us, we are buying dips in this market, and we are looking for market dislocations during this time. Um, you know, at times of big liquidations, there are opportunities in the market as well, um, where sometimes you can buy assets unfairly cheap or at a discount to spot prices if you look at futures and things like that. Um, for a fund, we are at the last day of March today. Um, and as it's looking now, the day is not over yet, but um, finishing March, we will very likely still be up for the year, so a positive return year to date, which is very different, I think, to many other markets, and in particular the stock market, which is down sharply this year to date. So I think that's a real positive. We are still very excited about the DeFi space. There are some amazing things being built there. As an example, coming months we will see an explosion of the number of synthetic assets that can be traded on platforms like Synthetics that we have written about. We see increased volume in DEXs, in platforms like Kyber. We see that token economics really matter. Numeraire is an asset we've been written about. It's been really gaining traction, and price-wise has been really positive as well for the portfolio. We will soon see trustless movement of Bitcoin to the Ethereum platform, and Bitcoin will be able to interact with DeFi apps, which we think is really interesting as well. On a portfolio basis, we are continuing to increase the participation in networks and thus be able to earn a yield on our tokens. And I think one silver lining is that despite the stress in the crypto markets the last few weeks, we have seen most of these crypto protocols handling the volatility quite well, and they're really being hardened by it. Developers are looking at what can go wrong with this type of volatility happening. A lot of DeFi projects are backed by ETH in one way or another. And with the huge volatility in Ethereum, this is really a stress test. And it's probably good to have such a big test this early in a new ecosystem. And another thing that I like to point out is kind of in looking at the macro situation is that Bitcoin got started during the last financial crisis. So this is the newspaper The Times from January 3rd, 2009. And looking at the first Bitcoin transaction, it referred to this headline here: Chancellor on brink of second bailout for banks. So Bitcoin was really made for this kind of environment. Um, we don't With Bitcoin we don't have to trust the central banks not to print more of it. You can't do that with Bitcoin. I'd also like to show you a tweet from Ryan Selkis. He's the CEO and founder of Messari, a really good site for data aggregation in crypto. He wrote a little while ago, I guess a couple of days ago, if someone gave me $1 billion to run a fund, I'd buy Bitcoin, S&P puts, and dollars. What should this trade does this year? That trade probably will do quite okay, we think. Still upside in Bitcoin. Equity markets are a big question mark, I think, in this environment. And cash is probably not a bad place to be in either. Yeah, I think Ryan Selkis has been really early in terms of following the coronavirus as well. We've seen a lot of Twitter personalities being quite early in tracking what's happening. People like Ryan Selkis, Balaji has another one we've been following a lot. Nassim Taleb as well. There's an article with Nassim in the AFR today. There's worth checking out. Shamath is another one. He was on a podcast recently called we linked to it in a recent newsletter. I forgot the name of the podcast right now, but that was really good as well. And that's really everything I wanted to cover for today. And if you have any questions, we are always available, and you can also send your questions in the chat. And let me see if you have any questions. Someone likes to see Ryan and Rol's Twitter feeds. Is there any reason Peter Costello set up the Future Fund in 2006, which is a sovereign wealth fund? It currently has 212 billion sitting in there. Any reason this isn't being tapped during these times? While we have seen some chatter about sovereign wealth funds that might be tapped in other countries, I haven't heard anything about that being done in Australia. The government seemed to be able to find the funding for all these programs so far. I mean, it's really astonishing what kind of numbers we're talking about in terms of this fiscal stimulus being proposed right now. As I mentioned, 15% of GDP. And during the press conferences with the government, no one is really asking the hard questions how this will be paid for. I guess there's questions for another day, perhaps. But there will be a lot of debt and a lot of money printing as a result of this. Why are you so excited about synthetic tokens? Well, if you can bring any kind of instrument to crypto, that is really powerful, because then anyone in the world with a smartphone and an internet connection can access this different type of assets. And that's uniquely possible because of crypto. So that's why we are so bullish on networks like Synthetics that are trying to do this. There are other networks that are trying to do similar things as well. But before we had synthetic assets on crypto, you really only could access crypto assets like Bitcoin and Ethereum. And then of course we have pegged assets, um, like Tether, for example, that is pegged to the US dollar. But Tether is not a synthetic assets. It's actually backed by US dollar in a bank account, which um, doesn't make it trustless and permissionless. It, in my view, interact with the traditional financial system in a way that takes away many of the benefits of open blockchains. So if you can preserve the permissionlessness, the trustlessness of open blockchain and still be able to trade any type of assets, I think that's really powerful, and that's why synthetic assets are so great. Balache is great. He was sounding the sirens on Twitter weeks before COVID became an issue. Yeah, I agree. He's been a fantastic job, and he has a background in biotech as well. And he was considered for the FDA at some point in the government role. Thanks, Henrik. Thank you. Could you tell us more about what happened with DAI Maker System Keeper bug? Also, DAI broke peg and went to 114. Yeah, so that's really interesting what happened to DAI and Maker. And I think they had to print some Maker to shore up the system, if I'm not wrong. So what happened around the 12th or 13th of March is that the Ethereum network got really clogged up. There are so many transactions happening during the sell-off. So it was really hard to get transactions through on the Ethereum network. Fees went very high. A lot of it was about sending stablecoins and interacting with DeFi. And that was really the reason why we saw the problem with DAI and Maker as well. Why I believe there was a liquidation that happened on the Maker platform. So you have these keepers who are buying collateral at a discount, and they were able to buy at a very cheap price because the auction didn't work due to this congestion in the Ethereum network. I think that was the reason. I'm not fully up to speed on it, but I think that's basically the essence of what happened with Maker. So a lot of DeFi networks were under tremendous stress during the sell-off, and the network got congested. But mostly I think we came out okay. And as I said, I think this is great stress for the network this early in the ecosystem. And hopefully we'll see more scaling solutions coming to Ethereum that will solve some of these issues. Where's the best place to learn about these? I'm not sure what that is referring to, but maybe it's referring to some of the DeFi apps and protocols that I mentioned. One way is to go to our website that you're on now, apollocap.io, and we have a blog there. We also have a resource page on the website, so you can check that out as well. I'm going to show it here if I can. So if you go to our website, and you can go to resources up here. And if you want to learn more about crypto, there are a lot of links here for beginners, intermediate, and for more advanced people as well. So check that out together with our blog. Okay, let's see if there are any more questions before we wrap up. There has been a lot of talk about putting real-world assets on blockchains, so it will be good to see an actual application of the idea. Yeah, totally agree with that. Of course, there's a problem putting real-world assets on blockchains. You really can just secure digital native assets on a blockchain, we believe, if you want to preserve the security of open blockchains. but maybe it's possible with synthetic assets that I mentioned before. I think that wraps it up for today. Thank you everyone who tuned in, and you can always ask us questions over email, or you can go to our website and connect with us there. And if you're not signed up to our weekly newsletter, you can sign up on our website. But otherwise, we thank everyone who tuned in today, and hopefully I'll see you soon again.